we'll leave it at that. And yeah, I mean, clearly tilting towards the fact that Indian IT may not materially benefit from this entire AI boom. But let's take it across to Peter Cardillo, Chief Market Economist, Spartan Capital Securities LLC. Peter, hi, good morning, at least from where we're at. You know, trying to get a sense that plenty of moving parts with regard to how the US policy as well as tariffs will evolve. How are you seeing both of these variables in the larger scheme of things? And do you believe that that most of the growth that's been driven in the US is AI led?
Yes, indeed. But you know, just today we did get a first glimpse of the trade deficit for September. That was a delayed one, and it improved rather sharply. So that means that probably the second revision, which will be coming out next week for the third quarter, is likely to be closer to 4%. Actually up maybe about 2 or 3/10 of a percentage point. And, you know, that will indicate that the economy is rather strong. But it's a false reading, in my opinion, because in effect, what we're looking at here is a very uneven economy in the United States. And you pointed it out just a minute ago. And so what we're seeing here is that consumer spending is not really all that strong. It's being held up by, you know, the very wealthy and wealthy families in the United States. But most families, middle class and lower middle class, are struggling. And so these numbers, while they portray a strong economy, in my opinion, it's not. And if you looked at the Fed minutes today, obviously, you know, their bets on a December rate cuts have been scaled down. We have a very undivided Fed. And so they were interpreted as more on the hawkish side than on the dovish side. And so that could also present a problem. I kind of believe that once the macro news begins to flow, that the Fed will have very little choice but to cut rates in December, because the labor market is not doing well at all. There's been many layoffs, and we have not seen them because, unfortunately, of the government shutdown. And just today, you know, they announced that most of the back data is probably not going to be released because it's impossible to compile. And the data and the employment numbers that we were supposed to get out today will probably be combined with the November numbers, and so that just takes us back to the problem of not really knowing where the economy stands.
Right. But Peter, that's exactly the point, right? Given how divided the House is now on a December rate cut, looking at the Fed minutes, do you think the markets would be quick to price it in? And if indeed it's an unchanged policy in December, do you think the markets will take it well?
Well, I think the market, you know, over the past couple of weeks has been, past week or 10 days, I should say, has been under pressure. But most of that was due to the uncertainties over the AI sector, and Nvidia may have temporarily squashed that by eliminate that by coming out with some strong numbers. However, at one point or another, the market is likely to continue to worry about a rate cut in December. Now, I think if you look at the bond market, I think that's pretty much placed in a no rate cut at this time. You look at the yields, they've been really stuck within a range here. The 10-year note has been trading somewhere between 4.11 and 4.12, 4.13. It hasn't really done very much. And probably the best indicator of all is the fact that we see a very strong dollar. And that's due to the fact that the market is, at least the foreign exchange, has priced in probably a no rate cut.
Right.
However, again, I feel that with the numbers, when the data begins to flow, that bets on a rate cut will reverse.
Absolutely. Peter, thank you so much for your time today. Great to get in your thoughts as always.